Hello, everybody. Thanks for joining us today. We are excited to get started and talk to you guys about how to profit from the most dangerous market in the last 25 years. We're going to show you how to find good stocks, a few that are still available, how to do that with diligence, safety, intelligence, as well as avoid the ones that we think are most likely to be blow-ups. So, with no further ado, let's jump into it. Here are disclosures. Look, we are not investment advisors. We do not give out investment advice. That's up to you and your tax advisor or someone else, but not us. We are an information provider. We're a publisher. We provide insights, intelligence and insight you can't get anyplace else. Be interactive. I want to hear from you in the chat. What city are you from? What kind of investor are you in particular? We want to know what kind of investor, what kind of strategy you like. And then remember, at the end, I'm going to give you at least one stock ticker. We'll take the most popular stock chosen based on what people submit in the chat. I'm going to want to do some free analysis for you based on one of the stocks you care most about. So here's our agenda. First of all, why and everything's going up market can lead to disaster. I'm going to also go into detail on the secret that Wall Street has been keeping from you. You might think you know this secret, but I'm going to give you the real inside scoop. And this is something you're not going to hear anywhere else. And next, we're going to go over how to avoid the Wall Street traps. And this secret goes into just exactly how asinine these guys are in terms of the traps they lay, how to use Wall Street's lies and how they're cheating against them. The silver lining in all this is that this secret is a secret because they don't want you to know how to beat them at their own game. I'm going to show you how their own failings, their own cheating gives you an advantage. And I'm going to reveal 3 stocks that you need to sell immediately. These are stocks that are bad in so many different ways, it's sort of not even funny. And then lastly, I'm going to do 3 stocks, not just one, 3 stocks based on popular demand by the end of this presentation. So let's talk about the market right now in a mathematical, objective perspective. You know, new constructs are really not about hyperbole and emotion. We'd like empirical proof, not narratives. And what we're going to give you is a practical plan for making money in the second half based on real data, not headlines. And I promise you that by the end of this meeting, you're going to have a completely different view on the markets than you have right now. First, on the surface, markets couldn't look better. Every investment, bullish strategy is working. Bulls are winning. We're seeing all-time highs everywhere. Stocks, home prices, Bitcoin, money supply, national debt, right? Everything just, it's an up, up, up. Stocks from all the sectors seeing huge gains all across the board. You've got Uber, General Electric, health, semiconductor stocks, defense stocks, energy stocks. And it appears that stocks will keep going higher. There hasn't been a red July in 10 years. So it looks like this winning streak is set to keep on going. Money supply has jumped 4.5% year over year in May to a record 21.94. I think it's the latest data we have. Note that this even exceeds the post-COVID record of 21.86 trillion. And I think all of you all probably know that, look, money supply is a huge driver in markets. Fundamentals don't matter. And when we saw the meme stock crazy height, and when we saw the bad IPO height, those were all very much driven by increases in money supply. And when you listen to the media, nothing could go wrong. When you listen to Wall Street, nothing could go wrong. Keep buying. Keep buying. That's what they want. What are some warning signs? The Shiller PE ratio at 38 is the second highest since the dot-com bubble. The market has only been valued this richly during 4% of its entire history, and a lot of that's in the recent time. We're also in a peculiar phase where the market seems to interpret all news as positive, right? Good news is good news and bad news is bad news. Fear and greed index has been at or near extreme levels for 15 plus months, right? People are kind of nutty. They want to buy it, make it go up no matter what. For example, a company reports strong earnings, stock goes up, makes sense, right? How about a company that misses earnings expectations badly and the stock still goes up? Here's a case study. Back in May, despite a highly negative earnings announcement, NVIDIA stock surged 6% in pre-market trading the next day. They beat expectations on revenues. They missed on earnings per share. And the company warned it could lose as much as $8 billion in sales the next quarter due to the restrictions. Despite all this, the stock went up. There is no such thing as bad news for the popular stocks. And despite a barrage of negative news concerning tariffs, a swelling fiscal deficit, slowing growth, and heightened geopolitical risks, the S&P 500 and Nasdaq remain near all-time highs. Like nothing can make this market stumble, it appears. No matter what, things just keep going up. We think that's something you should be concerned about. And part of the reason is because any negative surprises are expected to lead to a more accommodative Fed or more stimulus rather than, and which is only going to put off people reassessing fundamental risks. In other words, logic has left the building. Motion and momentum, not fundamentals, are in the driver's seat. The easy trades have also left the building. The Magnificent Seven is dead. I got this from my friends at DataTrek. Great research, by the way. The Mag 7 has lost their edge versus the S&P 500 over the last year. Despite beating the index by 85% of the time during the last decade, investors are now picking winners and losers between US big tech names. Those that best leverage AI are outperforming those that don't. The Mag 7 is now what they call the Fab 4. The question you need to ask, who will the Three Musketeers be? Or the Dandy Deuce? Or the Chosen One? What we're saying here is that markets have been so high for so long that it's that we're, even with the money supply growing, the markets are beginning to be more discerning. You can only run things up so much, just like we can only run up our debt so much before the rest of the world might start to question whether or not they should keep buying it, because they can do the math. When the interest expense becomes the biggest expense we have, and we're born just to pay interest, and we can't actually pay the rest of our bills, that's where we're in real trouble. There is a limit to how much debt we can have as a country. There's a limit to how much money supply we can pump in, and we think we're approaching those limits, which is why we've already seen the Mag 7, the most popular stocks possibly in the history of the world. This is the biggest market cap stocks of all time, the biggest amount of market cap added in the history of the world, right? And those are starting to falter. Markets are becoming discerning even amongst these most popular stocks. This is the definition of a market walking a tightrope. When everything gets interpreted as bullish, regardless of the actual data, we're in dangerous territory. This brings us to the most important question for your capital for the rest of the year. How do you make money when markets are priced for perfection? I already told you, the crowded trades aren't working so much anymore. What are you going to do? The answer isn't to guess the direction of the market, unless your crystal ball is working. The answer is research that gives you the truth about fundamentals and valuation of stocks, regardless of the noise. And that's exactly what we're going to show you today. My goal is to give you a guidebook to navigate these uncertain times. A guidebook that you can trust, not just narratives, but a guidebook that works in good times and in bad times. You don't have to be dependent upon momentum and emotion to be successful if you've got a strong foundation. That's what we can give you. And if you're unfamiliar with new constructs or why I'm qualified to talk about any of this stuff, let me introduce myself, David Trainer, founder of New Constructs. I've been doing this work for over 25 years. Our stock picking has beaten buy-side professionals, 16,000 of them, to claim the number one spot in multiple categories for 49 straight months on some zero. Again, a buy-side only network of professional investors. I'm not competing against the folks on Seeking Alpha or some retail platform. I'm competing against real pros. There it is. Number one for 49 straight months. Number one in industrials and in other categories. It doesn't hurt that our research has also been vetted and validated by some of the most prestigious institutions in the world. MIT Sloan, Harvard Business School, Ernst & Young, and the Journal of Financial Economics have all published papers proving, they empirically prove that our research is superior and generates superior results based on the proprietary data and ontology that we use. We've been able to recommend many lesser known hidden gem stocks in the past. This is what we do. We find what the market is missing because we have better information. For example, Williams-Sonoma, it's up 494% over the last 8 years versus S&P up just 162%. Yeah, we're talking about 8 years. 8 years because you care about where your money is 8 years from now than you do just 6 months from now. This is what we call real value creation. reliable value creation, not just trying to guess the direction of the market. Jabil, 200 up 266 over the last 4 years compared to the S&P, just 55%. Sprouts Farmers Market, a 428% gain over 4 years versus the S&P, up 59%. Plus, the performance of our actively traded indexes based on our research proves our value add for you. I mean, what can I say? For example, here's our very attractive stocks index. Outperformed for the first half by 0.5%, outperformed by 77% over the last 5 years. This is a live traded index. You can look up the ticker. There it is up here at the top of the screen. You can look up the ticker. And this is based on our very attractive stocks. All the stocks that get our very attractive stocks rating. Right? And I mention this because you guys are going to see we have a very, very sophisticated and powerful rating system. How about the core earnings weighted S&P 500 index? This is an enhanced version of the S&P. This is where we say, we don't even have to pick the stocks. We'll let someone else pick the stocks and we'll still outperform. Why? Because we can weight them in a more intelligent way. We're going to weight them based on core earnings, not market cap or equal weight, right? And we've outperformed in the first half, and then we outperformed by 31% over the last 5 years. That's a lot. All right, we can do even better. How about the core earnings leaders index? This is an index that focuses on the companies with the strongest core earnings in the market. Out of the top 1,000 stocks, which of the companies have the most understated accounting earnings, or which companies have the core earnings that are much the most in excess or beat the accounting earnings by the most, right? Which stocks have stronger core earnings than accounting earnings? Which stocks have the most misunderstood profitability? That's the core earnings leaders index. Practically doubled the S&P 500 in the first half of this year. Double, beat it by 7% in the first half, right? Data as of July 4th. And beat it by 48% over the last 5 years. So between Harvard Business School, MIT Sloan, and these indices, I think you can say, our stuff's pretty reliable. Our stuff's pretty reliable. Throw on top of that our actual stock picks with some zero, and with the ones I share with you, I think you can say our work is pretty reliable. It's important to remember a key quote from the Oracle of Omaha. Be fearful when others are greedy, and greedy only when others are fearful. Now, while the markets are hitting all-time highs, seemingly from every asset class, our research finds there are still plenty of stock opportunities in the market with massive upside potential. So I'm giving you something special. Yeah, you need to be fearful when everybody's greedy. You also need to be smarter, and we can give you that. Now, these gains we think we can happen in the next 3 to 6 months. For example, LifeVantage. It was added to our most attractive stocks model portfolio and increased 39% in the next month. Allison Transmission, added to the most attractive stocks model portfolio in February of 2024, was up 24% in the next month. Crocs, added the most attractive stocks model portfolio in May 2024, up 22% in the next month. Finding good stocks in a dangerous market is not easy. Only 4% of the stocks in our coverage universe get our very attractive stocks rating. But it is entirely possible, if you have the right research, to find good stocks. Because the truth is, you're being misguided by Wall Street and the media. So many investors are vulnerable right now because they are relying on flawed research. The information provided by most financial media and Wall Street is by its nature incomplete. And I'm going to explain why. Here's what's happening. Standard analysis relies on easily manipulated numbers that don't tell the full story. The crucial data needed to get the truth is buried legally in the footnotes of the 10K and 10Q filings. We're talking about thousands of pages that are so complex that most professionals ignore them. Wall Street wants you to ignore them too, because Wall Street's business model depends on you buying stocks. Their paychecks are tied to investment banking and trading volume, not on providing accurate, unbiased research. It's important for you to understand that. They don't get paid for giving you good research. They get paid when they sell stock. So they're going to always write research that sells stock, or those research people get their heads chopped off. This is a huge conflict of interest. Now, a lot of you know that. It's been going on for years. You've heard me talk about this. But the real secret here is that this conflict is not just something you need to be wary about. It's your advantage. It's your biggest opportunity to beat the market. Because our research enables you to turn Wall Street's cheating ways against them. Once you know their cheat code, well, then you can use it too. You see, our AI uncovers the truth to decode Wall Street's fake numbers so you can beat them at their own game. Here's the secret Wall Street does not want you to know. And Wall Street will do anything they can to keep you from finding out because it will remove the wool from your eyes and give you the key to beating them at their own game. You see, Wall Street analysts have to please their bankers or they get fired. Here's an example. A guy I worked with at Credit Suisse, Mike Mayo, still in the business. From this article in The Observer from 2001, this has happened to Mike more than once, unfortunately. But you can see Mike, during the bull market, Mike had a sell list. And he was right. Stocks crashed, but he got little thanks for his call. There were some who appreciated his blunt views, but the banks on the receiving end were less enamored, to say nothing of his employer. So when CSFB merged with DLJ back in September 2000, Mr. Mayo and his team of analysts were fired. They were ranked number 2 in the world. When they were fired, they were replaced by a lower ranked DLJ banking team. You can look this up. Here's the link. Let me know if you need it. Kyle can drop that into the chat if you want it. Let us know. This is a true story. It's a perfect example. And the market's littered with these. Ask anybody who's worked on Wall Street. They will tell you. Wall Street fires analysts who don't help them get investment banking deals. Period. So what does that mean? These guys have to write bad research. They have to put bad numbers out there. Everybody's playing with those bad numbers. The Wall Street people can't tell the truth. But you can know the truth if you use new constructs. We can give you the edge that lets them beat them at their own game. You beat the Wall Street analysts all day long because you don't have to please the bankers. Wall Street writes favorable research and makes up numbers to support all these buy and hold ratings. But you do not have to please the bankers. You just need to look out for yourself. That's the secret. Pretty easy, right? You get to use true research that Wall Street analysts cannot use. They can't use it or they get fired. That's the secret Wall Street is keeping from you. It's that simple. You don't have to rely on them. You can get the truth and you can act on it on your own. You can choose to use better research, unbiased, independent research that's proven to outperform. Let me read that again. Unbiased, independent research that is proven to outperform. Does it get any better than that? Somebody put in the chat how it gets better than that, and I'll give you a free copy of our latest long idea. So what are you waiting for? Do you like using biased, flawed research? Do you like having to rely on headlines and momentum? How can you trust buy ratings when Wall Street rates over 50% of the market as buy? Only 4% of the stocks we cover get our very attractive rating. We rate the majority of stocks as unattractive or worse. Who would you trust? The people who rate most everything a buy or the people who are more discerning? Here's why protecting yourself is more important now than it's been in the last 5 to 10 years. In a market where emotion and momentum are driving prices, Wall Street research is most dangerous. Wall Street keeps saying buy, 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 even while stocks get more and more overvalued. Do you notice that? When the market's going up, how everything gets more and more bullish? CNBC gets bullish. The media gets more bullish. Wall Street gets more bullish. Why? Because they make money when you're buying. Meanwhile, the rising disconnect between price and value creates both disaster risk and extraordinary opportunity. But only for those with the right research. You got to know how to crack the code if you want to see where the good and bad stocks are hiding. Consider this data point, and I want you to really think about this. 96% of stocks covered by Wall Street are listed as buy or hold. 96%. Does it seem statistically possible that 96% of all publicly traded companies are a good investment at any given time? 96%. I don't think the market's very efficient if 96% of stocks are worth holding. That's effectively saying 96% of stocks are undervalued. That's a highly inefficient market. You shouldn't be it. If the market's that inefficient, you shouldn't be in it at all. I'm not here to say the market's inefficient. I'm saying that there are times when the market's more efficient and less efficient. But I'm always going to say, and you've heard me say this, and you can read it in our education, the majority of stocks are efficiently priced. It's hard to find the good and bad stocks. They're hidden in the corners, especially when everything is at all-time highs. Or maybe do we think that Wall Street research is undermined by the firm's need to generate investment banking and trading revenue, right? What is it? Does it seem that it's statistically possible? No, no, it's not possible. They have to give out more buy ratings than they really want to, or they get fired. Meanwhile, our AI agent, which has no conflicts of interest, no investment banking details to protect, rates stocks as follows. Only 4% get our very attractive rating. Less than 13% of our stocks have an attractive rating or better. Very, very small percentage. We're discerning because we do real work. Don't you want people to be discerning when they give you research? Here's the buy ratings, 57%. 57%, right? It's not 96%, which is buy and hold, but 57%. So almost 60% of the market is a buy right now. Is that a good idea? Do you believe that? Do you not believe me? And what I'm telling you, the secret is that you don't have to rely on this and you can actually beat them at their own game by going against what they do, as long as you know where they are most wrong. We've also found specific stock examples in recent history that were rated as buys by Wall Street and compared them to our rating system. So specific examples of where these buy ratings have gone way wrong. So according to Wall Street, New Fortress Energy was a buy all this year. According to New Constructs, it's been unattractive or neutral rated the whole time. The result, stocks down 72% year to date. Ouch. How about Wolfspeed? Wall Street gives it a buy rating. New Constructs, unattractive. Result, down 80% year to date. Now, this is in a market when everything else is doing great, guys. Remember that? Almost everything is at all-time highs. Not really. It's not as good as things aren't quite as good as Wall Street wants you to believe. How about Moderna? Buy or hold from Wall Street. Unattractive from New Constructs, down 19% year to date. Given the differences in buy ratings, whose buy ratings are you going to trust? Aside from conflicted interests, another reason for the market's distortions is the reliance on the wrong numbers. This is part of how Wall Street plays its game. Those of you who've been following us for a while, you know I wrote a big expose on my direct experience with analysts cooking the books, so to speak, in order to support their overly optimistic buy ratings. Now, GAAP earnings are subject to accounting adjustments that can completely obscure the true operational profitability of a business. It's another way of saying accounting rules can be manipulated to mess with the numbers. Our company exists. It's part of why I created New Constructs and our technology to reveal these distortions in earnings. And you can see this in our professional membership. We got charts that show this: economic earnings versus accounting earnings. This is the difference. The accounting earnings doing this, economics doing, there's a big difference here. We show this for every single stock we cover. And Tesla is a perfect example of the disconnect in today's market. I know this is a lightning rod stock. And some of you are going to say, oh yeah, whatever. Tesla fundamentals don't matter. That's fine. I get it. But you know what? Let's just do a little bit of math here to understand what's going on with this one company. It's a great story. Everyone knows Elon Musk's maybe the smartest guy in the history of the world. I get it. But our analysis of the actual filings shows a business that's decelerating. It's not a growth story. And yet the valuation is quite crazy. We see everything shrinking, deliveries, margins, everything. And all the promises with autonomous vehicles, it's not really working out. I could go on and on and on. I'm not going to make that an argument. I just want you to show the numbers. Right? Let's look at the gap between economic and reported earnings getting worse. Yeah, things were going well for a while. Folks, it's dropping off a cliff. They're not letting you see it. They're trying to hide it, but eventually it catches up. They can't fake these numbers for too long. There's only so many one-time gains that you can put in your numbers before your auditor's going to quit. Just like happened with SMCI, Super Microcomputer. Last August, right, when their auditor quit, right? We warned about that before anyone else. We saw a warning with weak internal controls, all right? I'm not saying that's what's going to happen with Tesla, but when you see disconnects like this, it's potentially a harbinger of bad news. But the stock has stayed elevated. We're not talking about investing, folks. We're talking about speculating, right? The market's got a new rule. Good news is good news, and bad news is also good news. We've seen this. Everything gets spun positive. We're seeing it all the time from all the Wall Street analysts. No matter what happens, it's a positive. And our goal isn't to chase. You got to keep in mind, in new constructs, we don't have to chase after investment banking deals, nor are we driven to inflate any company's earnings or spin a negative story into something positive. Our commitment is to deliver the unvarnished truth, earning your trust through clear and honest reporting in our ratings. We meticulously analyze every detail. We do work nobody else does. Even when I was on Wall Street, people would be like, "Oh, what are you doing, database boy? Look at all these numbers." Why? Because I care. I think it matters to give people the truth. I think it's something to be proud of, and I want to be proud of my work. Sure, I could have made hundreds of millions of dollars, or billions even, probably, if I'd stayed on Wall Street all this time. I'm not interested in that. Transparency is our ethos. We provide comprehensive insights into how we calculate every metric in our models. I want you to know how much work we're doing. I want you to see what we're doing because I want you to challenge other people to be just as transparent because they can't. So you can trust us to reveal the full story of a stock 100% of the time. You also may be wondering, sure, your stock ratings at new constructs are different from Wall Street, but how do we know they are better? As mentioned before, number one ranked stock picker on SumZero for 49 straight months. Top institutions in the world prove the superiority of our ratings and data at every level. When you look at the true economic earnings evaluation of a business, you get the facts behind any stock. This will help you make far better investment decisions with you or your client's money and can help you uncover hidden opportunities in the stock market, such as Provident Financial, added to the most attractive stocks model portfolio, up 18% in the next month. Dorian, added to the most attractive stocks model portfolio, up 18% in the next month. It works on the other side too, folks. Shifts in our ratings to unattractive or very unattractive warn investors about stocks about to fall. Steph, added to the most dangerous stocks model portfolio, down 30% in the next month. National Scene Media, added to the most dangerous stocks model portfolio, down 24% within the next month. Adtran Holdings, added to the most dangerous stocks model portfolio, down 18% in the next month. Don't forget about our live traded Bloomberg indices, right? The very attractive stocks index beat the market by 77% over the last 5 years. The core earnings weighted or the enhanced S&P 500 beat it by 31%. And the core earnings leaders index beat it by 48% over the last 5 years. If you want to survive and thrive in the 2025 market, you need trust. You need research you can trust. You need independent, superior research to get an edge over all this noise. Why would you trust someone who's conflicted? Wall Street and the media, very conflicted. Making money, selling stocks, not when you sell, but when you buy. That's why they want up, 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 buy, buy, buy. If you've been part of our community for a while, you know what our edge is, how we get it. It's our robo-analyst technology. It's the first, best, and only AI for investing. And our ratings are simple. They're very straightforward, right? You've got 5-point system. You can see here, you can see that very attractive, right? That's the best. This is the worst. Same is true for all these things across here. 5-point system, economic versus reported earnings, which I showed you a chart of before. Return on invested capital, Warren Buffett's favorite metric, which measures the amount of cash flow the business generates relative to how much capital goes into it. Super intuitive measure. Hey, I need to understand not just how much money the company makes, but how much money the company makes relative to how much capital's gone into it, right? If they're making $1 million a year and they've got $1 billion of investment, not good. Invested capital is $1 billion, only making $1 million. That's not good. But if they're making $1 million a year and people only put in $2 million in that business, well, that's great. So that denominator matters. Wall Street never talks about the denominator. Name a time that Wall Street's talked about the denominator. Put it in the chat. I'll give you a free report. Then we got three valuation metrics: the 2-year average free cash flow yield, our price to economic book value, and our market implied growth appreciation period. These are some of the most sophisticated valuation metrics in the market, including this market implied growth appreciation period, which is all based on our reverse DCF model, the best in the business. I highly recommend our reverse DCF case studies if you've not seen those. Now, the key thing about this AI is it has the ability to comb through thousands of financial filings with precision, analyzing every line and every footnote. That's why executives from some of the biggest firms in the world are using this. Not what they give you, but their own personal trading. And we make it simple. Green means good, red means bad. Did you know that we're the only stock rating system with a patent? Again, throw in the chat anyone else who's got a patent in the research business. I'll give you a free report. Our robo-analyst has processed and structured data from over 200,000 financial filings. Its experts have gone through and created effectively the perfect model based on this filing, organized data perfectly. That's what teaches our system. Now, the number of filings we've analyzed is multiples of that because we've gone through and used these perfectly marked up filings to train our system, to train our auto parsing technology. So it's millions, 500K over 500K, but all based on meticulously marked up and reviewed expert labeled filings. So therefore, new constructs, we've analyzed 2 times as many financial statements as Warren Buffett and counting. We're the AI of Mr. Buffett, right? This is from a Wall Street Journal article saying that they think Mr. Buffett read 100,000 filings in his lifetime. And we use a proprietary technology to standardize complex financial disclosures into accurate measures of core earnings and free cash flow. These metrics are proven vital for assessing a company's true financial health. As a result, our robo-analyst helps us identify stocks such as Allison Transmission, up 47% versus the S&P 26%. That's since it was added to the most attractive stocks model portfolio. Our robo-analyst technology leverages AI. This is the key: to do research that most people don't do and to do the proper due diligence on your behalf. That's how we give you an advantage. We do stuff that no one else does. That's what Tom Brady says. Tom Brady says you got to do. To win in this world, you have to be willing to do things other people will not do. You have to go the extra mile. That's how you get an edge. There's no shortcut to that. And our robo-analyst technology gives you an edge based on analysis in the footnotes, which is what the Harvard Business School paper proves the market is missing. Most investors and professionals don't have time to read 200 plus page 10Ks and 10Qs and do proper diligence. It's a lot of work. Trust me, I've done it a ton. That's why I created technology to do it. The process costs millions of dollars per quarter for firms to get proper calculations. People are doing this manually, millions of dollars per quarter. That's why nobody does it. It's just easier for firms to blast out, buy now, buy now. Now, earlier we hinted at a guidebook to navigate 2025's overvalued and uncertain market. And with your permission, I'd like to get into how you can get that exact guidebook today. Imagine this: you're sitting at your desk, sipping your morning coffee, and then in less time than it takes to watch a rerun of your favorite TV show, you've adjusted your portfolio to weather any market storm. You've identified the hidden gems poised for explosive growth in the current market, and you've sidestepped the landmines that could blow up your portfolio. The best part, you don't need a PhD in finance or a supercomputer to make it happen, because our AI agent will do all the hard work for you. So what is the guidebook I've been hinting at to help you navigate 2025 and beyond? It's our most attractive stocks model portfolio. The comprehensive nature of our research entails countless pages of data and documentation, including information from balance sheets, income statements, cash flow statements, footnotes, dozens of other disclosures. This is what goes into picking the most attractive stocks. This produces and maintains a level of detailed research that would set you back millions of dollars each quarter. There's no cheap way to do this. We're the only people that have done it. And with our most attractive stocks Model portfolio, you get the stocks delivered to you on a silver platter. That's the beauty of all this. We've done the hard work to build these models on thousands of companies for really the entire US stock market. We scour that entire market based on that superior data to pick the best of the best. That's how we do so well with our stock picking. We can look at the entire market and identify what's good and what's bad. Now, let's get into some more details on how this all works. Stocks make our most attractive list because they have high quality earnings based on high returns on invested capital and economic earnings and cash flows that are positive and rising. Right? I showed you that rating system before. You got to have an attractive or better rating to be on the most attractive stocks list. And you also have to have a cheap valuation. This is what risk reward is all about. I got a business that's generating a bunch of capital. I got a business generating a bunch of profits. And then I got valuations that are saying the opposite. Valuations saying that profits are going to decline, go to zero, or disappear altogether, right? That's great risk reward where the market's got it wrong. That's the whole point. That's the part of the secret that Wall Street doesn't want you to know, is the market gets it wrong, but only in small spots. You need to have the right information to decode where the market is getting wrong. That's why Wall Street's telling you the market's getting it right so much. They want you to trust them, trust the market's just right. But we all know that in order to generate outsized returns, you have to know where the market is wrong. And you can't just do that following everybody else's research. You got to have something special. That's what we do. How about some recent examples from our current model portfolio? From the June model portfolio, in the first 2 weeks that model portfolio was out, 3 stocks up 31, 11, and 8%, while the S&P was up just 1%. The most attractive stocks through the first quarter of 2025 is up 504% since inception, compared to the S&P at just 289. With this portfolio, we're constantly refreshing and reviewing to find the best stocks in the market. It's updated every single month. In fact, in July's update, we added 9 new very attractive or attractive rated stocks to the portfolio. Avoiding the wrong investments is just as crucial as picking the right ones. There's 2 sides of this story, folks. You've often heard me say the famous quote from Ben Hogan, hey, golf is not so much about how well you hit your good shots, but how badly you hit the bad shots, right? One bad stock can ruin your life. That's where the second component of this guidebook comes in. It's our most dangerous stocks model portfolio. That's part of the guidebook. You need to know the good and the bad. We need to make sure you don't hold any stocks that are going to blow your portfolio up. Stocks that make our most dangerous lists do so because they have misleading earnings. Counting earnings doing this, real earnings doing the opposite. Counting earnings going up, real earnings going down. Opposite. Right? Rising and positive gap earnings while economic earnings are negative and falling. They also have low returns on invested capital. And even worse, they have expensive valuations, very expensive. Low to negative free cash flow. Price to economic book value ratios that are really high. And a growth appreciation periods that are very long and very high. Very expensive. So, opposite of most attractive. Expectations for huge cash flows in the future and bad profits. That's what makes them dangerous. A disconnect. The market's expecting profits to zoom higher while profits are actually going down. For attractive stocks, profits are going up, but the market price is implying profits will go down. They're the opposite of each other. Again, we're taking advantage of our technology to look at the whole market and identify what's in the dark corners of bad stocks and good stocks. You want to see some performance of the most dangerous stocks model portfolio? From the June portfolio, in the first 2 weeks, 3 stocks down 4 to 5%, or the S&P was up over the same time. So net negative 5% relative return in just 2 weeks. Since inception, the most dangerous stock short model portfolio has outperformed the S&P, down just 72%, while the S&P and Russell 2000 are down 87%. Our model portfolios, not surprisingly, are trusted by some of the biggest and best advisors, RAs, and hedge funds in the world. Merrill Lynch, Morgan Stanley, Raymond James, you name it. The top investors in the world have used these exact model portfolios to make investment decisions for years. Now, you're probably wondering, what's the price of these 2 model portfolios? Here's what it would cost for you to do it on your own. First of all, if you want to look at how expensive it is to do this kind of research, In the first quarter, we put together a model to track how many hours would be required to do the work to go through the filings. And if you're assuming that someone gets paid around $100, $100 an hour to do this kind of work, which is what's required in terms of expertise, $2.5 million of time to go through the filings. That doesn't count the research and the technology and analytics to still scour the entire market. That's just to get the data, my friends. That's just to get the data. And our clients, our institutional clients, pay us a lot of money for this research. Big bucks. However, you don't have to pay that. You don't have to pay 155, 121,000 a year. You only have to pay 5 or 10,000 a month. And we make it easy for you to trust us. We give you pre-screened stocks, both attractive and dangerous, delivered to your inbox every single month on a silver platter. The regular price for our most attractive and most dangerous model portfolios, $3,500 a year. Keep in mind, we're at a critical inflection point right now in the markets. The second half of 2025 is likely to be very different from the first half. Investors who prepare now will be the ones who prosper when the market sentiment inevitably shifts. We're already seeing that with those Mag 7 stocks, the ones that are the most overvalued. We're already seeing the market start to say, oh, wait a second, we just can't make everything go up forever. We're going to start being smarter about where we allocate capital. Positive return streaks like this can't continue forever. When they break, they tend to break pretty hard. And the investors who are prepared will be the ones who can still make money. Of course, I can't make the market rational. I can't prevent corrections or crashes, but I can give you the tools to succeed whatever comes next. And when I talk about our performance, right, we don't talk about short-term performance metrics. We talk about long-term. We're talking about 4 or 5 years. Sure, when stocks get added to the most attractive and most dangerous stocks list, sometimes they move right away. Why? Because you got a lot of big investors paying attention. But they don't pop back, right? That's why I'm able to show you stock picks that do well over long periods of time, like 4 to 8 years. Because I can give you an edge to beat Wall Street at its own game. Wall Street's handicapped. Wall Street analysts are fighting with one arm behind their back because they got to please the bankers. They can't be honest. I can give you the truth about earnings evaluation. Our system doesn't try to time the market. It focuses on finding businesses with strong fundamentals at reasonable valuations, regardless of market conditions. This guidebook gives you the tools to make those adjustments in your portfolio with confidence and with ease. All of our research reflects the latest earnings and filings. This means you're getting the most up-to-date information possible. We believe our research can serve as your asset to find the winners and losers and avoid the landmines, rather than do the opposite as described in this Peter Lynch quote. Selling your winners and holding your losers is like cutting the flowers and watering the weeds. That's what Wall Street wants you to do. These new attractive stocks often uncover new market-beating opportunities in the stock market. As we noticed this past year, Universal Insurance Holdings added to the most attractive stocks model portfolio, up 13% in the next month. Haynes Brands added to the most attractive stocks model portfolio in 2024, up 13% in the next month. Chimera Investment Corp added to the model portfolio, up 13% in the next month. You don't just have to take our word for it. How about some of these testimonials from our clients? Along with your integrity, we appreciate your commitment to maintaining high standards and your courage for saying so. New Construct is at the top of my list of respected companies. I highly endorse the New Construct system as one must-have tool in any stock or fund selection system. How about this? I sincerely appreciate all the work that has gone into creating New Constructs. Going from marked up footnotes and filings to reliable, easy to understand indicators is a huge undertaking. I find New Construct information to be reliable, relevant, and trustworthy. I found your analysis superior. I know how financials can be manipulated as a former business owner. Your research digs that out. I rarely buy something that does not have solid ratings for New Constructs. It provides me with concise insights I couldn't duplicate on my own. Folks, you notice how much people trust us? Trust is not something that's normal these days. right? Trust in most institutions at all-time lows. Surprised? No. Trust is hard to find. When you can find someone that you can trust, that's a big deal. In new constructs, we believe in transparency and authenticity and only recommend stocks we believe are truly valuable based on superior data, not stocks we are compensated to promote or rate as attractive for a paycheck. Let's take some questions. When are these model portfolios released? Each model is released the first week of each month. So you'll get those most attractive, most dangerous stocks reports the first of every month in the first week. Common question number 2, how many stocks will come with each portfolio? Roughly 40, 20 large cap, 20 small cap in each model portfolio. If there's not enough, there'll be fewer. We don't force 40 stocks in. Sometimes there's not enough. Like sometimes like during heavy seasons of when new filings are coming out and we know the data is about to be changed and it's old, we pull stocks out of coverage because we know we're about to get new data and we don't put them on these lists. We don't make them eligible for these lists. So, but generally about 40 stocks. Are the stocks placed in these model portfolios guaranteed to have double-digit returns? No, nothing is guaranteed. No stock rating system can ever promise a specific return. While we are highly selective with which stocks we grant an attractive rating, we cannot guarantee the stock will explode in the near future. Nothing is guaranteed in this business. What if I already have one of the model portfolios? Your membership will be extended depending on the monthly option you select. We can just add on top of what you already have. So your good money spent with us remains good money. What if you have more questions later? That's what my masterclass is for. Join. Or you can email us at support@newconstructs 24 hours a day. Now, let's get to the free stocks to dump immediately. I told you in the beginning, I was going to share which stocks you need to dump immediately. Here are the tickers: CAR, SIGI, and Axon. Let's take a look. I got a model portfolio right now in my system. I got a bunch of portfolios, zombie stocks, CNBC stuff, stocks to dump now. 3 stocks to sell right now. Why? Well, let's take a look. This is the same view as our professional membership. I'm logged in with an institutional membership because, hey, I'm going to drive the best if I can get access to the best. Let's take a look at some details here. Siemens, looking bad all the way across the board. By the way, it's in the most dangerous stocks model portfolio for July 2025. Hint, hint. There you go as a freebie. Earnings distortion score, miss. Very attractive, very unattractive in 3 out of the 5 categories. Looking really bad. Super expensive, misleading earnings. What do we mean by misleading earnings? Accounting earnings going up, economic earnings going down, my friends. Bad news. Yet the valuation is super high. Free cash flow yields very low to negative. And one of my favorite metric here, economic book value. Look at the stock price going way up when economic book value is going down. Bad sign, right? The difference between this blue line and the red line, that's all future profit required to justify the price, right? Think about everything below this line. That's what the company's making now. Not a lot, right? The value of the business, economic book value per share, that's 32 bucks. This is 127 bucks. So the difference between the two, right, about $100 a share, 98 bucks a share. The difference between the two is all future profits. So super risky when that large a portion of the stock is based on future profits. Lots of risk there. Let's take a look at Carrier Global. Double bad too. Oh, another one added to the most dangerous stocks model portfolio in July 2025. That one just came on. Interesting. Again, very unattractive rating in 3 out of 5 categories, misleading earnings, but we're going to see the same thing. Accounting earnings going up, economic earnings going down. Very bad. Shares outstanding going up too. Not a good thing either. Returns on invested capital headed down. Bad news. All right, let's look at the third one. I got something special for you in this one. Not only is this a very unattractive rated stock, but it's got weak internal controls warning by the auditor. Remember I mentioned super microcomputer? Remember what happened to that stock late last summer? A little bit less than a year ago? Crushed. Why? Weak internal control warning. Who was out there telling you about it before the market knew? We were. We were a couple of weeks ahead of that announcement. We flagged it in the news and we flagged it in the filing. And eventually their auditor quit. Not a good sign. So yes, very, very unattractive in 4 out of 5 of the ratings. And it's got weak internal controls, folks. Bad news. Bad, bad news. Add that to our list here. Gets a neutral rating. So neutral. What can I say? It's a big meh. Not so great, not so bad. Valuation, get some greens, profitability, green and yellow, not great. I think we're going to see trends. It's getting worsening, but not turning around, but not worsening as much. Shares going down, that's good, right? They're not flooding the market and diluting investors. Let's see here. Is a credit rating? How's the credit rating look like? Attractive on the credit rating. Cash to debt, not so great. I'm guessing that it's not so much the debt. They don't have a lot of cash. Interesting. All right, I said they would do 3. So I'm just going to look at who's been most recent in here. NEM, Newmont, mining stock, neutral. Interesting time for commodity stocks. Interesting time given what's going on around the world and prices for certain commodities. So you get another neutral here. This is kind of all over the board. You got green and red, yellow and orange. You've got everything. Very interesting. But yeah, neutral. All right, we got time for one more. I'm going to go with the most recent. Agnico Eagle Mines. Neutral. Sorry, folks. Nothing too exciting. I guess that's why you need the most attractive, most dangerous stocks reports. If you want to know where you can reliably go to get good research, it's the most attractive, most dangerous stocks reports. There's no other system that's going to give you as accurate a read on any one individual company. And there's no other system that can do that work at scale across thousands of stocks so that it can reliably give you the most dangerous and the most attractive stocks in the market. No one else has a product like this. No one else has performance like what we do. No one else has technology like what we do. And no one else has integrity like we do in the investing business. That's New Constructs. Thanks so much for your time today. I appreciate the interaction. Hope you guys like the stock picks, and I hope you enjoy this training.